Guys and girls, welcome back to Vermont Outlook's Beginners in Fundamentals course, and today in session 6 we are taking a look at interest rates, the third and final golden brother, which we refer to as the big brother in the analogy. First of all, to truly understand why interest rates are a tool, why they're the big brother of the three golden brothers analogy, and the true effect interest rates have across the whole economy, we must first understand what a central bank's role is and what central banks are and why they are important before discussing interest rates. A central bank, also known as a reserve bank or monetary authority, is an institution that manages the health, currency and monetary policy of an economy and oversees its commercial banking system. In contrast to a commercial bank, such as Barclays, Citibank, HSBC, a central bank possesses a monopoly on increasing the monetary base. The main role of central banks is to implement and adequately conduct monetary policy to achieve efficient price stability, such as low and stable inflation, and to help manage economic conditions and encourage growth, leading to a stronger nation. In short, central banks aim to keep an economy running healthily, hence the big brother title when referring to interest rates. We'll see how this correlates with GDP and inflation in due course. As we already know, a central bank's inflation target annually is 2%, ever since 1966, due to the decades and decades of data collection of many economic booms and busts, leading to the average inflation rate of an economy that can grow healthily and handle the growth is 2%, whilst prices do not dangerously increase too much or too little. Since 1966, Fed policymakers have generally adopted the stance that their target for doing so was around 2%, which led to other major economies coming in and realizing that 2% is actually the true sweet spot for growth and prices to coexist. Interest rates are the third and most important brother in the analogy of the Golden Brothers due to the power and effect the alterations in interest rates have. Decreasing or increasing interest rates are there to help an economy get back on its feet or to slow the growth and inflation of the economy when both GDP and inflation are getting out of hand and a bit wild. Interest rates and inflation are closely related. In general, when interest rates are high, borrowing costs become more expensive, and consumers and businesses are less likely to spend money because they're borrowing less. This can lead to lower inflation. Conversely, when interest rates are low, borrowing costs become less expensive, and consumers and businesses are more likely to spend money. This can lead to higher inflation. Additionally, central banks may raise interest rates to try and curb inflation if inflation is getting out of hand. By decreasing the supply of money in the economy, this decreases spending and in turn causes prices to cool in an economy. Interest rates predominantly have one main objective when you alter them, to either increase or decrease the money supply in an economy. As we know, more spending equals more GDP, and more GDP equals more inflation, and more supply of money in the common economy, and this now leads to money being worth less due to more supply of it. Therefore, the central bank, keeping true to their aim, attempts to decrease the supply of money in a market, thus decreasing spending, which decreases GDP and in turn, economic activity with it. This leads to less inflation from a consumer-driven scenario. Of course, when GDP is low, of course, inflation then is low as well, and the opposite is true. Interest rates decrease to encourage more spending. There are three main targets and areas interest rates affect in an economy that ends up decreasing and removing supply of money and capital within a common economy. Let's take a look at them. We have cash deposits, VMRs, which are known as variable mortgage rates, and VLRs, which are variable loan rates. Let's break down one by one what these are and what they represent. Cash deposits. The relationship between interest rates and cash deposits is that the higher interest rates are, it makes it more attractive for people to save their money in the bank. When interest rates are high, savers can earn a higher return on their cash deposits, which makes it more beneficial for them to save the money rather than spend it on goods and services or even invest it. And this leads to a decrease in spending, which of course it decreases the creation of GDP, by proxy lowering inflation. Higher interest rates can lead to an increase in the amount of money held in cash deposits, as people are more likely to save their money in accounts that offer high interest rates. And additionally, when interest rates are high, it can make it more expensive for firms to borrow money, which can lead to lower investment and lower economic growth, and less transactional activity is occurring. Think of it in the property market sector, When interest rates are low, it is cheap to take on debt. Therefore, individuals, companies are taking on debt and purchasing property, therefore supplying the market with money. The opposite to this is also true. If interest rates are high, less people and firms are borrowing money and less money is being injected into the economy. Now, when interest rates are low, savers are less likely to put their money in cash deposits because the return is low, but instead they are more likely to seek other forms of investment with higher returns, in other words, spending. This can lead to a decrease in the amount of money held in cash deposits, with the capital likely being injected into the economy, generating GDP, harbouring growth and leading to inflation. In summary, the relationship between interest rates and cash deposits is that higher interest rates make it more attractive for people to save their money in cash deposits, and lower interest rates make it less attractive for them to do so. When interest rates are low, savers invest less in cash deposits due to the low returns and instead look for other forms of investment with higher returns, which tends to translate in GDP generation. This may reduce your cash deposit holdings, but then again, the relationship between interest rates and cash deposits is that the higher interest rates are, the more cash deposits become. And it's more attractive for people to save money and keep cash deposits there. And the lower interest rates are, the less attractive it is to do so. Variable mortgage rates. A variable rate mortgage is a mortgage loan with an interest rate that varies based on the market current interest rate. This is the binary opposite to a fixed mortgage rate, which essentially is an arrangement between a mortgage holder and a mortgage issuer of a pre-agreed rate of interest that will not alter until the mortgage maturity agreement is reached. When discussing VMRs and interest rates, once again it comes back to the supply of money in the market scenario. When interest rates are moving higher, the cost of borrowing is also increasing. Due to this, fewer people are taking on debt and mortgages. This leads to less investment in the property market and less circulation of currency. Two birds with one stone comes to mind here, because not only are consumers taking on less debt, but those who have mortgage on variable rates, VMRs, are now paying more back each month as the rate of repayment increases. But why does this slow down the supply of money? Think of it like this. When interest rates are increased, more monthly outgoings on bills arise, such as mortgage repayments. And due to this, consumers have less disposable income each month to put back into the economy on things that essentially is disposable. This decreases the spending overall in the economy, known as aggregate demand. This decreases the GDP, and this decreases prices across board as businesses are trying to attract revenue and survive, and in other words, this decreases inflation. Prices cool off in an economy, but we need to understand something. This is a double-edged sword. So let's think of it when interest rates are cut in an economy. The lower interest rates are, the more they're decreased, the less monthly outgoings on bills, for example, mortgage payments. This increases the disposable income households and consumers have to spend. This increases the likelihood of spending from those consumers, which likely increases GDP and in turn increases inflation as businesses capitalize on this increase in demand. Prices increase in the economy and the cycle continues, and we're back into a recovery, growth, expansionary phase. Variable loan rates. Did you know in 2022, 65.1% of the population in the UK had some form of loan? When taking VLRs into consideration and their reaction to interest rates being altered, it soon becomes apparent as to how powerful interest rates are, the big brother, on the supply of money within the economy. Remember, the more spending and supply of money in a market, leading to inflation, the less each unit of currency will buy due to inflation. Hence why the more inflation, the more we are near the peak on the economic cycle. The lower the inflation moves, the increase in the probability that we are nearing the end of contraction or recession or bottom of the economy from an economic cycle stance. But more about this shortly. The effect of interest rates moving higher or lower when referring to VMRs is nearly identical to the effect of VMRs in a general loan stance. When interest rates are increased, the more monthly outgoings on bills, the rate at which consumers must pay their loan back increases. This decreases their disposable income, this decreases spending in the economy, this decreases GDP, and this decreases inflation by proxy. Prices in the economy cool off. The big brother has stepped in. This is a double-edged sword. Let's think of it when interest rates are cut in an economy. The lower interest rates are, the more they're decreased, the less monthly outgoings on bills, for example, the rate of which the consumer must pay their loan back decreases, and due to the variable loan rate, increases in disposable income become apparent, and therefore the consumers likely spend whenever they want, wherever they want, because they have that extra bit of money each month. The increase in spending translates to an increase in GDP, and this in turn generates more inflation, and eventually the prices in the economy begin their upward trajectory and the cycle continues. Now let's summarize on an increasing interest rate scenario. The average consumer will view interest rates moving higher as a bad thing, as they owe more on their debt. But investment bankers have an opposite binary view to this. Interest rates are a tool used by central banks to control the rate at which spending, the supply of money, is occurring within an economy by decreasing the demand for goods and services. If interest rates are moving higher, it's usually due to a central bank wanting to slow down the rate at which spending is occurring. In other words, GDP is increasing too fast, and inflation being above 2% can be a good gauge of this. Investment bankers view this as a thank you for admitting you're growing too fast and that you have to slow down the rate of your economy's growth and spending. In other words, this is a very good indication that the economy and its currency are in high demand and are in its phases of expansion, growth, or booming within its economic cycle. The investment banker is quite literally very, very, very happy to see interest rates moving higher. Decreasing interest rates. When interest rates are cut by a central bank, the average consumer is happy. They have more monthly disposable income to play with and spend due to fewer mortgage and loan repayments per month, whilst yielding very little interest by keeping capital in the bank. But an investment banker acknowledges that a central bank is likely moving rates lower as spending is uncomfortably low within the economy, or GDP has declined enough alongside inflation cooling down that spending now needs to reoccur within the economy, or they may risk entering a recession, or even worse, a depression. Therefore, they cut rates to incentivize spending, essentially. This is usually known as a bad or painful move for an economy's native currency, as the central bank is essentially admitting, of course in the eyes of an investment banker, that their economy needs growth, needs spending, and is struggling. The central bank quite literally is reducing the consumer's monthly outgoings in order to help them put money back into the economy to regenerate spending. Remember the triangle of society: consumers, businesses, government. If consumers aren't spending, businesses aren't making money, therefore governments are getting no taxes. In order to regenerate spending, a government will decrease, or a central bank will decrease the interest rates. Therefore consumers are spending more, businesses are revenue more, and incomes are taxes for the government once again. Holding interest rates. When a central bank holds rates and doesn't increase or decrease them, it means they are simply satisfied with the health of the economy and the current state of the economy. There comes a time where a central bank essentially are just satisfied with how much they've increased or decreased their interest rates, and this is known as the terminal rate. When a bank finishes their hiking cycle, which is an increasing interest rates, we can refer to the peak in the economic cycle, whereas when a bank has stopped cutting rates, we can draw reference to the bottom of the economic cycle. Now let's take a look at this from a visual stance. So here we have the economic cycle. And so far, guys and girls, one thing we do know is when there is expansion and growth and periods of strengthening in an economy, we see inflation occur. A central bank doesn't like prices to exceed 2% because this is where prices become too hot and you're risking prices becoming abnormally high for consumers, which will lead to a peak sooner rather than later, and then of course contraction and recessionary measures follow. Now, in order to prolong the spending in an economy and try to keep prices at the 2% inflation level, the sweet spot, a central bank will essentially raise interest rates to prolong and extend that period of growth and slow down the consumer's demand within that economy. Hence why it's the big brother. I like to say it like this: when GDP is happy and inflation is happy, for example, this side of the cycle, they mimic each other and they grow and they grow and they grow. And the big brother steps in and says, hey, my little two brothers, you have to calm down, because if you go parabolically happy, you're going to crash real and become real sad. So in order to slow down how happy you get and just make sure you're happier for longer, we're going to introduce interest rates, because I am the big brother interest rates. Now, there is a saying: central banks take the stairs up with interest rates, because they're trying to find out how much interest they can put on the economy without crashing demand and strangling the outgoings of consumers. Now, once an economy has seen a peak, GDP starts to flatten, inflation starts to flatten with it, a central bank knows it has raised interest rates high enough to curb demand and therefore is going to bring prices lower. Now, again, going back to the three Golden Brothers analogy, once we start to see an economy hit a contraction or a recession phase, the big brother acknowledges this. In other words, let's go back to the emotional side of it. The first little brother GDP in the black pen here, GDP is sad. He's decreasing. You know, the little brother GDP is becoming sadder and sadder and sadder. And so is inflation. Inflation is mimicking and becoming lower and lower and lower. Businesses are struggling. Prices are becoming lower. Consumers are spending less. So the big brother acknowledges this, interest rates, and essentially steps in to intervene and to help get spending going again, to increase the probability of decreasing the time that the economy spends in this downturn. So as I was saying, the saying as it goes for interest rates are, they take the stairs up and the elevator down. As such. Now, to the left over here, we would refer to this side of the economic cycle as buy-side economies. When economies are recovering, expanding, growing, booming essentially, we want to buy into that growth. We want to get behind that strength. And we refer to this side of the economic cycle, or let's do it more so like this. We refer to this side of the economic cycle as sell side, where you see contractionary, recessionary, depression-based economies that are shrinking, struggling, and really showing signs of weakness. Here we have diverging situations. The economy this side is increasing quite literally, whilst the economy this side is decreasing in economic output. Guys and girls, thank you as always. You know where to find us for any further guidance and help. Have a great day and take care.